morning and welcome to the Blackfinch seminar on VCTs and EIS. My name is Dominique Butters and I'm part of the BDM team here at Blackfinch. And you have me for the next hour talking about all things tax. But first of all, of course, we have to have those risk warnings. Now, I don't know if many of you have seen brochures for EIS since December, but the FCA, bless their little cotton socks, now make us put on the front of the brochure, do not invest unless you're prepared to lose all of your money. Thank you, FCA, very helpful. What I would say is, though, you can understand where they're coming from because EISs are very high risk. But that's why we structure our EIS in such a way, and we'll look at that later. And of course, they don't take into account the raft of tax benefits and tax reliefs that clients can get. So again, we'll look at that and we'll actually look what's the real risk here. Another point they actually want us to make as well is that you're unlikely to be protected if something goes wrong from the FSCS point of view. What I'd say is everything we do at Blackfinch is actually 100% ring-fenced from Blackfinch. So heaven forbid, touch wood, we're a highly successful, profitable company, but if anything happened to us, actually it's irrelevant to your clients because it's 100% ring-fenced, normally just in nominee name only. We are literally investment managers, so just bear that in mind. And of course, FSCS doesn't cover performance anyway. You won't get your money back quickly. Absolutely, certainly, obviously this is about EIS. In fact, I often joke to people and say, you know, even if people die, you can't get the money back because you have to wait until those companies are sold. That's probably the single disadvantage to an EIS actually. But again, we'll look at actually when it's part of an overall portfolio because it's never going to be all their money. Hence point 4, don't put all your eggs in one basket. It's never going to be all their money. It's only ever going to be a small part. But quite an important part. So we'll talk about that as well later. And the value of your investment can be reduced. Absolutely. But with EIS, that's why you have all those tax breaks and indeed loss relief, which we'll come on to later to soften that blow. General important information. This presentation is for financial advisors. It is not designed for retail clients. And everything we're talking about today is based on current legislation and our understanding. And as we all know, legislation can change. So just bear this in mind, but please don't share this with retail clients. And obviously, we're not giving advice here as well. So what are we hoping to achieve, our learning objectives in this 1 hour CPD session? Well, we want to show you how and when to use a venture capital trust or an enterprise investment scheme. That's one of the questions I get all the time, actually, when I'm speaking to advisors. Well, when do I use an EIS and when would I use a VCT? So hopefully this presentation will make it that much clearer. And then we're going to talk about, well, what type of clients and how would I position this with a client? So we'll look at that as well. And then due to popular demand and questions we've had from other seminars, we are going to talk about a lot about the risks. How do we position this? Because again, biggest objection I find with advisors on, do you know what, Dominique, I love these VCTs, I love these EISs, but I don't have any clients who are risk rated 10. So how can I possibly recommend it to those clients? How can I get this through compliance? So we'll talk about that as well. But first of all, an introduction to Blackfinch for those of you who may not know who we are. Well, our founders were inspired by Charles Darwin and the Darwin finches, hence the name Blackfinch. And we are all about adapting and evolving and thriving because that's what you need to do. We don't want to be one of those fuddy-duddy companies that just stuck in their ways and things move on and they haven't. We've all dealt with those companies. They're really irritating. And actually how we built our products is actually based a lot about feedback from advisors. So, and one of the reasons I actually joined Blackfinch 6.5 years ago was because they were smaller, younger, more nimble, more open to ideas. And, you know, I speak to you guys, I know what you're wanting. So that was really a brilliant opportunity for me to help shape what we do. So if you do have feedback on what we can do better or new ideas, please share them. And at the end, there will be a feedback sheet, which will be online, which is perfect. Don't forget to scroll down, by the way, to answer some questions online so you can get your CPD certificate. But on there will be questions. So if you've got any questions from this presentation, please put them down there, because then your local BDM can actually get in contact and answer those questions. But again, any feedback for us, that would be really helpful. Thank you in advance. Now, we've actually been around for 25 years now as investment managers, and we built up experience across multi-asset investments. So again, many people don't realise, but we do what I call normal investments as well. So we have NPS, we have our funds, and coming very soon, we're launching something new in that space. So watch this space, that's very exciting. And I think it's going to be incredibly popular with our advisor market. But also we have experience in the renewable energy sector and property lending, and that's through our Adapt IHT portfolio, the one that targets capital preservation, where we're sort of targeting between 3 to 5% returns there. We also have AIM, which can also be held on platforms. So we're currently available on 10 platforms on AIM as well as direct. But the ones we're going to concentrate on today is in the startup and scale up investing, which is through our EIS and VCT. We currently have over 650 million in funds under management and growing quickly. And when we launch this new investment strategy, I think that's going to go up very quickly. And that's across 140 people. So we have 140 employees spread out throughout the whole of the UK. So especially with the BDM team, we have always have office contacts, and then we have people like myself out in the field, and we're right across the whole of the UK and Northern Ireland. But something else that we really focus on is ESG. Now, a lot of people say to me, Dominique, have you just jumped on that bandwagon? No, actually we do take it really seriously. In fact, so seriously, we actually have a dedicated ESG manager to make sure we're taking it very, very seriously. But again, what helps us is that because we're really focusing, we can choose those companies that are not only helping the UK economy, because let's face it, that's why we get the tax breaks, but they're also doing some good. Now, I know you're going to say, oh, my clients don't really care, a lot of them. But actually, when they find out they've invested and their money is doing good, they do actually think, oh, I actually like that. Oh, that's really good. So they might not have chosen to invest in it, but they do get that feel-good factor that they are actually helping not just the UK economy with these investments, but helping in other ways as well. And I'm going to give you a couple of examples of some of the companies we work with, and actually you'll see that ESG factor in there and what we're meaning by investing for good. But what we are not advisors. We are purely investment managers. Why is that important to you? It means we are never going to try and pinch your client. We do not have a regulatory authority to give advice. However, we want to support you, support our advisors, because without you, we're nothing, okay? So we want to do everything for you, with you. So if you want a BDM to come with you to a client meeting, because let's face it, we do this all day, every day, we should know all the answers, we are very happy to do that. You can't send us in on our own to talk to your client, because that could be perceived as we're giving advice. But very happy to go along with you, explain what we do, how it works, the tax breaks, examples of how it's invested, speak to accountants, speak to solicitors with you, because again, we don't want to go into solicitors and accountants without you, because they can't refer to us. They need to refer to an advisor. So we're there to support you. And as part of that support, we're not daft. We do not expect you, after 1 hour's CPD, to know everything about a VCT and EIS. This is really to give you a flavour of what these products can do for you and your clients. Please use us. Your BDMs are your friends. We're a free resource. We would love to come and chat to you about particular clients and cases and help you along the way with those. And let's face it, if you didn't need us, we'd be out of a job. So please need us. When we talk about ESG, though, we talk about duty of care to protect the environment. And with that, we have an online portal. So everything can actually be accessed from a client and advisor point of view on the portal. So we try not to print everything. So that actually helps save costs as well, because you know how much it costs to print everything. But not just that, why put it in the waste paper basket? It's such a waste, isn't it? So everything's available online on our portal. If clients, though, specifically do like a piece of paper, and we do get those clients who do, usually the elderly ones, that's absolutely fine. The default is the portal. However, we're happy to send out hard copies in the post. Just let us know. But ESG is never, ever costing you for actually your clients growing their wealth. So ESG is important, but it's not at the detriment of growing their investment. In fact, actually, if you speak to one of our fund managers, it can really help grow your clients' investment by being ESG. So don't ever think we're doing that at the detriment to your clients' wealth. And as I mentioned before, we are all about adapting, evolving and thriving in our new environment. And let's face it, we are living in interesting times. So what do we actually have available? Well, we have the Adapt IHT portfolios. Those are the ones I mentioned, invest in renewable energy and property lending. Those are the ones that target capital preservation. We have our AIM portfolios. Again, come direct or through a platform, available, as I said, on 10 platforms now. Number 5 is our Thrive Corporate Management Service. That's for the product where if you have businesses, companies that got far too much cash sitting in there, it can cause them major issues. They could lose their trading status and not get business asset disposal relief, entrepreneurs in old language. They don't get IHT relief on surplus capital, and it's probably not earning anything. Now, I'm going to talk about a strategy later to get that money out of the company. But this product's for those people who say, no, I need to leave it in there. I might buy another business. I might not buy another property. Well, this product gets that money trading and basically sorts out their tax issues. So please come to us if that's an issue for any of your clients who have companies. And as I mentioned, we have the asset management side as well. But the two we're going to concentrate on today is the Blackfinch Spring VCT and the Blackfinch Ventures EIS portfolios. Those are the two we're going to concentrate on. So without further ado, the Blackfinch Spring VCT. Well, why invest in a VCT in the first place? Well, to be honest with you, to start with, it's the tax benefits, isn't it? You get 30% income tax relief. Now, that's in the current year of investing. Okay, so VCT, current year of investing. The caveat is you can't get back more tax than you've paid. Okay, but with a VCT or EIS, you can get back all income tax. So whether that's from earned, pension, savings, rental, dividend, even chargeable event income tax when you sell a bond. So do bear that one in mind, because a lot of people won't sell bonds because they think, oh, I don't want to pay the tax. Well, let's face it, the bond, you're still going to pay a tax on death, but you can't do anything about it then. You can, during their lifetime, you can offset that tax liability. They also get tax-free growth and they get tax-free dividends. Now, tax-free dividends, if you think about it, most VCTs will do sort of 4 or 5%, and certainly we're targeting a 5% tax-free dividend from next year. Now, but 5%, actually, you would need to achieve well over 8% if you're a higher rate taxpayer to net it down to a tax-free dividend of 5%, and over 9% if you're an additional rate taxpayer. So we glibly say, well, 5% tax-free dividend, but actually that is huge when we think about those higher rate taxpayers. So you've got those tax breaks. You are limited on a VCT though. You can only invest £200,000 per person per tax year. And as I said, you are limited to how much tax you've paid. So if you've only paid £3,000 of income tax, you're only going to put in 10. If you put in 20, you're still only going to get your 3% or your £3,000 back in income tax relief. But VCTs are also complementary with other investments because they're giving you access to alternative asset classes. Because actually these companies that we're investing in, these tech companies, these tech enabled companies, these aren't listed funds. These aren't companies you can just go and buy shares into. So actually people can't get access to our companies without actually going through a VCT or EIS. And also, of course, you're diversifying tax wrappers. You're just using another one, aren't you? You've used their ISA, you've used their pension, now what? Well, actually, why not a VCT or EIS? Risk, I hear you say, don't worry, we're going to come on to that. But also, of course, we are helping to support those small growing companies and the UK economy. So again, many advisors say to me, Dominique, why does the government give us these tax breaks? I don't understand. It seems too good to be true, especially when we come to EIS. But actually, they're not daft. They're getting us and our clients to put all of this money into the UK economy, into these small companies. These are the ones that are creating the jobs and taxes. If you think about the big firms out there, the FTSE 100s, they're not creating jobs. All we ever see headlines is people getting rid of jobs and, things are closing. It's the small ones which are growing. That's the future of our economy. So the government are quite clever, really. Basically, they're putting 30% of their money into these small companies. We're putting the other 70%. Genius when you think of it like that. And that's why, though, we have strict rules on what type of companies can be invested into, because they want to make sure the money is going in exactly the right position. So, what type of clients, who, what, where and when to use a VCT? Well, probably the most popular use of a VCT is for those business owners. So I mentioned those business owners who have surplus capital. And I often find business owners, and you might be like this yourself, will take tiny salaries, rest in dividends up to the basic rate tax band and say, I'm not taking any more because I'm not paying higher rate tax. Well, that's fine. But if you are a highly profitable company and actually your profits are just adding and adding each year, as I mentioned at the beginning, that can cause issues with entrepreneurs, business asset disposal relief, and IHT relief. So it's not ideal, really. So unless you have it for a specific purpose, you should probably be getting that money out. Because let's face it, you're going to be paying the tax at some point. You're just kicking the problem down the road and the problem's getting bigger and bigger. So what we say to those people, and I have a slide on this actually, which is probably my most favourite slide of everything, is we say to people, look, take a dividend. And they go, no, I don't want to pay higher rate tax. And go, well, I know it's 33.75% now at higher rate. Go, yeah, I don't want to pay it. Just say, okay, if I could reduce that down to 3.75%, what do you think? They go, oh, I don't mind paying 3.75. It's the 33.75 I wasn't so keen on. All you're going to do is take that dividend, pop it into a VCT, potentially an EIS, pop it into the VCT, we can offset 30% of that tax. Don't forget, they've probably got money elsewhere, building society, premium bonds. They can always add a little bit more to it to completely negate their tax liability. They like that. Basically, it's a 5-year exit strategy for getting cash out of the company tax efficiently. But they will first of all say, oh yeah, I'm locking it away for 5 years. Go, yes, you are. And please don't do a VCT if they actually do think they might need it in the next 5 years. But a good question to ask them, well, how long has it been in the company for now? And they normally sort of bow their head and go, well, about 10 years. You haven't needed it. No. And also they might just put in half the amount they probably should do in the first year. That's fine. Because the second year, when they've built up their profits again, they'll say, I should have done it properly, shouldn't I? Yes. Well, they'll do it again the next year and they'll do it properly. But what I love best about having companies taking those regular profits out is you say to them, look, if you do this each year for the next 5 years, you're not going to pay tax, very little tax on your dividend ever again. What do you mean? Of course, the biggest benefit of a VCT is you only have to keep it for 5 years. After 5 years, you can take it out. So in year 6, when they take their dividend out, their tax liability, year 1, assuming no growth, no loss, you're going to take out the VCT, reinvest it in year 6, which is going to offset the tax on their dividend again, 30% of their 33.75. Year 2, it's going to do year 7. Year 3, it's going to do year, and you've got this conveyor belt. Oh, they really, really like that. So basically, they're going to invest their surplus profits for the next 5 years, and then from year 6 onwards, when they take that dividend, going into their back pocket tax-free. Whereas I like to call it funds under management, because obviously you're not going to allow them to actually spend the money, but what a brilliant strategy. And if we want to take it one step further, and this can actually help you sell pensions as well. Often company directors don't bother with pensions. They say, oh, well, my business is my pension. And you're thinking, oh, for heaven's sake. Or some people will say, well, what's the point of the pension? I get the tax relief on the way in, but they're just going to hammer me on the way out. Whereas what you could say is, okay, well, how about if you could get all the tax relief going into a pension, and you can also get it back out tax-free as well? You've got their attention at that point. All you're going to do is a pension and a VCT at the same time, because when they've sold that company, I mean, I'm doing this myself. So when I stop being a PAYE and I don't have any earnings, we'll have a pension. So when I have my investments coming out every year, let's say for argument's sake, got £50,000 coming out, which I could then reinvest, get another £15,000 of income tax. But all of a sudden, the business owner isn't actually being taxed now. I'm not being taxed, but we do have a pension. So you just go, okay, I've got £15,000 of income tax I can offset. How much can I get out of my pension? You can take a big lump out of their pension, create an income tax liability, because the VCT tax relief is going to offset it. And you can do that every year. So they could end up getting all of their money out of their pension completely tax-free. Now, I mentioned this to an advisor the other day, and they said, well, Dominique, don't forget, they can do a VCT every 5 years and get 30% tax relief every 5 years on the same money. Brilliant. I said, when it comes to retirement, they could then just drop it into their pension at that point and get another bit of pension tax relief. But a very good point. So again, VCTs are complements to pensions. It's not as an alternative unless people really don't want a pension, but they do work beautifully together. What about landlords? So your landlords, a bit scuppered on pensions, aren't they? Because they don't have that net relevant earnings. So, you know, rental income doesn't count when you're actually looking at pension provision. But what is a pension? It's just an income in retirement. So what about doing a VCT? Now, if you said to a landlord, well, okay, you've got all your rental coming in and you're getting taxed to hell on it, as you are now, but what about we can get all that tax back? I'm thinking, really? Yeah, we can get all that tax back. Let's say they pay £6,000 of income tax a year, pop 20,000 into a VCT, do that each year for 5 years, they'll never pay tax on their portfolio ever again. But the beauty is, in retirement, that VCT, of course, is paying out tax-free dividends. So actually, those landlords might not bother taking out year 1, reinvesting in year 6. They might actually say, well, no, I'll keep investing because that's my pension, really. Because in retirement, they've got a great big load of VCTs all paying out those tax-free dividends, which is just another name for a pension. just a different type of one. But again, what are you doing? You're just being creative with those tax wrappers again. That's all you're doing. Landlords can't do that. Yeah, you can have an ISA, but how about making them a non-taxpayer? Other ones, high earners wanting to get extra tax relief. You've done the pension, you've done their ISA, now what? Why not get them some more tax relief? Because I always think about a VCT or EIS as being part of an overall diversified portfolio. So I always think of a portfolio as sort of a bit of a triangle. You have your building blocks, and that top bit of the triangle is where you have the exciting investments. That might be emerging markets, global equities, it could be smaller companies. Well, in my mind, why wouldn't you have that little exciting bit as a VCT or potentially an EIS? Because the upside is unlimited and tax-free, and the downside, well, think of VCT, the downside, you've got 30% buffer. Don't have that with any other investment, do you? So why not have their exciting bit of a portfolio as a VCT potentially? Again, you're just being creative with the asset allocation. That's all you're doing. And when it comes to risk, if you think about that, it's never going to be a large part of somebody's portfolio. It's only going to be a small part. And therefore, even if a client is a risk rating 3, a 4, a 5, actually as part of an overall portfolio, you can put in a small piece at, a risk rating of 10. It's absolutely fine, because you're going to have that balance in the portfolio across the board. And that's one of the key points when we're talking about risk and talking about it with compliance. And clients, to be fair, it's only a small part of an overall portfolio. I have seen people in the past make the mistake with compliance of saying this client has gone from a risk category 5 to a 10. No, please don't do that. It's just a simple case. If they're a 5 or a 5, you're just going to put in a report for this particular pot of money. They are happy to take a 10 out of 10 adventurous risk, whatever your compliance department risk rates is that, for this particular pot of money, because they want to benefit from the 30% income tax relief. They like the idea of tax-free dividend. They like the idea of tax-free growth in addition to their ISAs. They're happy to be investing it for 5 years and being able to actually access that later on. So you're just building a case, but it's never all their money. It's just part of an overall diversified portfolio. That generally flies through compliance, especially if you're not doing more than 10% of their assets. If you're doing more than 10, you probably got to write a bit more of a story, but that tends to be, if it's going to be larger, it tends to be an EIS. But again, we have those extra tax breaks to make it worthwhile. Those people who are limited on pension contributions, so either the seriously high earners or those people actually they're going to be hitting that lifetime allowance, or perhaps, those doctors who are already fully funded and having to pay excess charges on their pensions because they've got such great final salary ones. So again, you can't do the pension. What else could you do? Why not a VCT? As I say, later on, we'll talk about might be an EIS. And I've got an example of the next one. It's those ones who may have already hit their lifetime allowance. So you might already be over it. And when you come to take the excess, all of a sudden it's a lot of tax. So we'll talk about how we can offset some of that for you. And then the last one, this is one that a lot of people don't think about, and it's their retired clients. So you're thinking, my retired clients pay very little in income tax at all. And it always makes me laugh. I always say to someone who's retired, and then you've probably got £500,000 or £1 million in funds under management with these people, but you've done such a good job with their portfolio. They're probably paying £3,000, £5,000, £6,000 of tax. But if you say to them, how do you feel about paying tax in retirement? Sit back, have your cup of tea, have the biscuit they provided you, because they'll probably rant for the next 5 minutes on how it's so unfair. They paid tax all their life and now you're getting taxed again. It's so unfair. And then when they finish their rant, you just say, So would you like to be a non-taxpayer then? Again, what are you going to do? You're going to say, well, look, how much have you got in the building society? Even with interest rates going up, still not really doing anything, is it? How much you got in the building society? How much you got in premium bonds? And you're never winning. How much you got in national savings? Well, look, let's move probably 10,000. 10,000 across into a government incentive where you're going to help the UK economy. Retired people normally quite like that when they're actually helping and investing for good. You're going to put 10,000 into this, and we're going to get your tax back this year. We're going to do that each year for the next 5 years, and you're never going to pay tax ever again. They're going to think you're an absolute genius. They're going to love you. But what's so funny is it's so show-offy. So what they do is when they go down to the golf club, they'll tell all their friends, I'm a non-taxpayer now. And their friends will go, how have you managed to do that? My advisor. Yeah, I'm not going to pay tax ever again. Brilliant. Great way of getting client referrals. So what I would say, conversely of that, if you, VCTs, people often say to me, Dominique, what's the point? They're so small. And actually, our average case is around about 23,000. So VCTs do tend to be small ticket investments. And you're not going to want to probably do that for every client because you can't be bothered. But do it for at least your top 10 clients. Those clients, if they walked out the door and went to another advisor, you'd cry. It would have a proper impact on your earnings. Do it for them. Because what you don't want to happen is another advisor on this webinar says it to their client, makes them a non-taxpayer, their client tells your client, and all of a sudden, well, my advisor's never told me to do that. Why have they never told me to do that? I pay all this tax. I'm always moaning about it. Then all of a sudden, you've lost that client to another advisor. So protect your clients. Make them non-taxpayers. They will love you for it. And as I said, it's going to be a very small part of their overall diversified portfolio, but it will mean so much to them. Now, this is the slide I was talking about. This is my favorite one because this just shows you visually invest each year for the next 5 years and you're never going to pay tax again. It's fabulous. So in year 1, we put in 20,000, you get your 6,000 tax relief. In year 6, we're going to take that year 1 investment. Caveat here, these days you can't bed and breakfast a VCT. So when you pull it out, you can't go back into the same VCT. Or if you want to, you have to wait 6 months. So what you're going to do is pull out in year 1, put it into your next favourite VCT, year 2, and so on and so forth. Of course, if you have a husband and wife, though, there is nothing wrong with them swapping. So again, you could set up a husband with one VCT, a wife with another. At the 5-year point, you just swap the 2 over. So actually, they're not out of that VCT for any time at all. So that one is really useful. Another thing to be aware of is with a VCT, it's not the company, it's not Blackfinch, it's not anybody else, it's the VCT itself. Okay, will charge a buyback. It will charge you normally between 5 and 10% of the net asset value to buy back those shares. And the idea is it's actually to pay the cost of re-registering the shares because it is expensive. It's not a profit-making situation here. And our buyback policy is at 5%. So it means it's like having an exit penalty, really. So when you come out, you're going to be paying 5% to come out of that VCT. But if you're reinvesting it into another VCT and getting another 30% tax relief, who cares? But do mention that, and we have it in our suitability templates, which we provide for all of our products. We do have that in there because you don't want it as a nasty shock to your clients at the end. And they go, well, I didn't know I was going to have to pay this 5%. Where's that come from? So just be aware of that. Now, this is a really good one to mention to accountants because it's a great way of getting clients who perhaps don't have advisors. Because believe it or not, a lot of business owners just chuck money into a pension. Do they have an advisor? Do they heck? And actually, they're the ones that can cause themselves real issues and being over the lifetime allowance. So think about your clients who might be approaching or going to be surpassing the lifetime allowance. and mention it to accountants who have clients in this situation. So people over the lifetime allowance, when they come to take their excess over the lifetime allowance, that's going to be charged to 55% if you take it as a lump sum. Okay, so let's assume they've got 100,000 over the lifetime allowance. You take that 100,000, then 55% is taken at source. So they end up with £45,000. Bit upsetting. Okay. However, you can reduce, and by the way, a recovery charge is non-recoverable. You cannot do anything to get that back. Okay, not an EIS, not a VCT, nothing. But you can reduce that non-recoverable recovery charge down from 55% to just 25%. And how you do that is if you take the excess as an income, and that can be as little as just 2 payments. So you could literally, you wouldn't, but you could literally take 99,000 in one and 1,000 in the other. That's fine. Because when you take that first payment, as long as it's not 100% of the excess, it's charged as an income. And then it's a 25% recovery charge. And the reason for that is the remainder, the other 75%, is subject to income tax. So actually, HMRC are tax neutral. But the beauty of being subject to income tax is that is recoverable under an EIS or a VCT. So when they take their excess, take it in more than one payment, and then 25% recovery charge, the rest being recoverable. So the little sales point here, to put it in a nutshell, you're reducing down the non-recoverable recovery charge from 55% to 25%, with the rest being recoverable. And let's face it, people over the lifetime allowance are going to be the most perfect type of client for having a VCT or EIS as part of their overall portfolio. But it's a brilliant way, if you like, to show off to accountants, because they're often really don't have a clue on pension legislation, especially these days. So you can actually drop that into conversation, say, look, if you have people who might be approaching this or might be in danger, refer them to me. Great, pension transfer immediately across to you, because you can help them in this way. So that's VCTs. What about EISs now? Right, first of all, why would you choose an EIS? Especially if we go back to that front page when I said about all these risk warnings on an EIS. Don't invest unless you think you can lose all of your capital. Well, let's take a look at the tax breaks. First of all, you get your 30% income tax rate, just like a VCT. But with an EIS, you can go back a year. So we can clear last year's tax bill as well as this year's tax bill. So that's the first benefit. You also get capital gains deferral relief, and I've got a couple of slides on this one. And actually, that's probably the biggest reason why people would use an EIS. You also get IHT relief because an EIS also qualifies for business relief. So once it's been held for 2 years, even if it keeps getting reinvested, it doesn't restart that 2-year clock. On death, no IHT once they've held it for 2 years. They get tax-free growth, just like a VCT. You don't get a tax-free income, though. You don't get any income with an EIS. It's all about the growth. But you do also get loss relief. And I've got a slide on loss relief, which really shows you the level of risk you're actually taking with clients' money. So that one, if you can get your head around loss relief, you'll never have an issue selling an EIS to a client because they'll just think this is brilliant. But they are high risk. We do expect some failures within a portfolio. To be honest, we're not taking enough risk if we don't have actual failures. But because of that, we'll always put you in a really well-diversified portfolio across at least 10 to 12 different companies. I mean, actually this year, if you're in by the 24th of March, which is our deadline for this tax year, currently we have up to 15 companies we could be investing in. So your clients could be investing in between 10 and 15 companies. This side of the tax year, you'll be fully invested this side of the tax year which means the CGT starts straight away, IHT 2-year clock starting straight away, income tax you can carry back to last year as well as using this year, and tax certificates, we'd expect to have those by about mid-June. Manage expectations, say, by the end of June to clients. So we're going to put together a beautiful diversified portfolio because we do expect failures, okay? And I've got a slide on that one later as well. Generally, though, we say we'll invest across, allow us 12 months to get fully invested. But what the team do, knowing that actually most people do tax planning in February and March, we actually back-end load a load and keep a load to be invested in at the end of the tax year. So if you invest on the 6th of April, I'll say to you, it could be up to 12 months before you're invested, and we'll invest in companies throughout the year, but then you'll have a big lump at the end of the tax year. So just be aware. But like a VCT, you're accessing alternative asset class, you're diversifying those tax wrappers again, and you're helping support those small growing companies, and you're helping the UK economy. That's why you're allowed to have these great tax breaks. One thing I would say is though, if you haven't done an EIS before, you're thinking, wow, this is amazing, this is brilliant. And we call it the Rolls Royce of tax planning because it's got pretty much every tax break you can have on there. People who've used an EIS, though, we often call them the one which is a right pain. There's an awful lot to an EIS, okay? So it is one of those you will need our help, and we will happily give our help because it's not particularly straightforward and maximising these different tax rates. We do this all the time. So when we're looking at a particular client, we can help you maximise all of those tax breaks. So do speak to us. So who, what, where and when, excuse me, to use an EIS? Well, actually, a lot of them are the same as the VCT, except now it might be they also have an IHT liability. So if you are putting funds into a VCT, do they have an IHT liability? Are they worried about it? Are they older? So if they're older, they might prefer an EIS which has that IHT benefit as well. So very generalization here. I often say VCT, younger, poorer people, because younger, they're not worried about IHT. Poorer, because actually they don't have CGT to worry about, or they don't have IHT, they're just trying to get their income tax back. EIS tends to be older, wealthier clients because all of a sudden they might have a property to sell and got capital gains tax issues. They might have an IHT liability. So with an EIS, I tend to say you want to benefit from at least 2 tax breaks to make it worthwhile, because there's a lot more paperwork and management goes on with an EIS than it is a VCT. So you want to be benefiting IHT and CGT, or CGT and IHT, or income tax and CGT. Or for the high net worth sophisticated clients, then they might say, especially the high earners might say, well, actually, my primary reason is income tax, but I can benefit from loss relief at 40 or 45%, which reduces down my risk dramatically, but my upside is tax-free and unlimited. So it does depend on the client, but again, your BDM can help you, and perhaps we don't advise, but we can help you talk about actually what's the advantages and disadvantages of both. But where I find we use EIS the most are clients who are selling something. So they're selling a buy-to-let, a holiday home, a share portfolio. They just don't want something anymore, but they don't want to pay the capital gains. And this is where you're going to help them. So how does capital gains tax deferral work? Well, first of all, it is only deferral. So we haven't got exciting, got rid of that tax yet. We'll come on to that. But when you defer the tax, you can never reduce the rate of CGT paid. And of course, we have 4 rates now. We have 10% basic rate tax on selling shares and investments, 20% for higher rate taxpayers. But for property, second properties, basic rates at 18%, the higher rate it's 28%. And of course, when we're working out what rate of CGT is going to be payable, the gain, the profit they've made on that sale, and this is crucial. A lot of clients think it's the whole amount. You know, they're selling a buy-to-let worth 250,000. They think they have to invest the whole 250,000 into an EIS not to pay the gain. No, it's the profit. So how much profit have you made after your annual CGT allowance, after any expenses? Let's say it's 50,000. You put that 50,000 into EIS and you defer that tax. But to work out the CGT rate, that 50,000 is added to their income for the year. And whatever's still in basic rate tax band is charged at 18%. Anything over and above is 28%. So actually, for a lot of people, when we are selling big assets, it is often at higher rate. But the beauty is when it comes back into payment, when we've deferred that CGT and it becomes payable again, it could well be at a lower rate. And I'll explain why on the next slide. So who can benefit from CGT deferral? Well, anyone who's made a gain in the last 3 years. So again, speak to your accountants. Who's paid capital gains tax? They paid it. You get it back again. You invest in an EIS, when you get your tax certificate, they can send that into HMRC, or they can change their tax return, either way, and they can say, I want my tax back, and they will get a refund from HMRC of the CGT they're deferring, just like they get that income tax relief back as a payment, again, when they put those certificates in. So you can go back up to 3 years and claim back CGT that's paid, or 1 year in advance. And that 1 year in advance is very handy if you've got people who are thinking of selling something. So if they're thinking of selling something, and perhaps you're already going to be doing maybe a VCT, perhaps for a company director, taking their dividend out and thought, right, we'll pop it into a VCT. Always ask the question, are you likely to sell anything in the next 12 months? Or would you like to sell something? Because if they do, you quickly switch to an EIS instead of VCT, still going to offset their tax, but now you're going to defer that capital gain, and we're going to look to mitigate that deferred capital gain later. So how do we mitigate it? Well, first of all, they could retain the EIS till death, because on death, CGT dies with you. Great for elderly clients, not so great for the younger ones who are thinking, blimey, I don't want to necessarily keep this the next 40 years. That might be a bit much. Okay, but older clients, and where we see older clients using it, it is generally for IHT mitigation. So I did one recently. Client had 1.1 million in a share portfolio with Fisher Investments. He was in his 80s, all subject to IHT. Well, actually, the advisor sold the portfolio. The gain was about 260,000, put the gain of 260,000 into the EIS. That was going to be IHT exempt in 2 years. We got a nice lot of income tax back for them, cleared last year's tax bill this year, and deferred the CGT. Now, he does intend to keep reinvesting that EIS till death, on death, no IHT, CGT's died with them. But actually the main driver was to release the rest of that money, that 800,000 from that investment portfolio, to do other IHT planning. Now, I was very lucky, went into business relief investments. So actually he got that whole 1.1 million IHT exempt in 2 years, but it didn't cost him a penny in tax to do so, because we've deferred that CGT, and that CGT is going to die with him. So it's a great way of moving clients out of one asset to do other planning, potentially perhaps IHT planning, or they might just not want that asset anymore. So it gets them out without it actually costing them anything for tax. Younger people, however, what we can do is perhaps use future annual CGT allowances. So let's come on to my next slide. let's say we have an EIS, and you'll see why I've done 30,000 across 10 different companies. So that 30,000 gain now, it was added to their income for the year, okay? And that, say, was all at 28% tax. But with CGT deferral, it's now going to get chopped up into 10 little bits, into those 10 companies. It's very unlikely to be even split, but for ease of maths, let's say it's even split. So they're in 10 different companies now. Well, these companies are going to mature at different times. So when one company matures, now that might have made them, that 3,000 might have made them 10,000. They think, oh, it's great, all tax-free, lovely, put that in their back pocket. But you're going to say, oh, don't forget though, we did defer capital gains of that 3,000. Well, the deferred gain now becomes payable again on that 3,000. But first of all, if you add 3,000 to their income for the year, actually, is that still giving a higher rate, or is now that at the lower rate? So instead of 28% CGT, it could be just 18%. And they might say, well, I'll pay it. But the other thing is, you're in a new tax year. If they haven't used their annual CGT allowance elsewhere, they can use that deferred gain and offset a little bit of their annual CGT allowance. Although in 2 years' time, the annual CGT allowance is going to be 3,000, which is why we've done this slide. However, life isn't like that, because actual fact, you might find it's that law that says 4 of these companies come out in the same year. You go, ugh, I've got an annual CGT allowance of 3,000, but I've got £12,000 worth of gain coming out this year. So you've offset 3, so you've got 9 left. Okay, well, am I married? Can I transfer some shares to my spouse's name and offset their CGT allowance? You might better do that. You could, of course, pay the CGT on the remaining amount, or what a lot of people intend to do is say, well, actually, why don't we reinvest that 9,000 into another EIS, get another 30% income tax relief, redefer the CGT? And basically, you can keep doing that every year, offsetting your annual CGT allowance. Anything that's remaining, you can reinvest, defer it again. So you can defer it indefinitely until basically there's nothing left. Now, I promised you that I would be talking about loss relief, because loss relief is really important within EIS, because people will often say to me, well, Dominique, you just said they're really high risk. How high risk are they? Well, yeah, they could go bust, which is why we have a diversified portfolio of at least 10 different companies. And then clients say, yeah, but what if it's an absolute disaster? What if every single company goes bust? What am I going to do? Okay, so what's the worst case scenario? Well, let's take an example of a 10,000 investment, and literally the whole thing's gone bust. Well, HMRC says, well, you haven't lost it all, because we gave you 3,000 in income tax relief at the beginning to start with, but you have lost the 7. So that net loss of 7 you can use with loss relief, and you can either offset it against income tax in the current year of the loss or in the previous year, or both, or you can offset it against deferred capital gains or any capital gains arising in that tax year, or you can carry forward and use it against future capital gains. So actually, you are all of a sudden bringing that risk right down. And if we take an example of a typical client who's a 40% income taxpayer, that's 7,000 at 40% tax relief. That's a further £2,800 in income tax relief he's going to receive on that £10,000 loss. So he got 3 initially, 2,800 in loss relief. So he's had £5,800 in tax relief. So how much has he lost? 4,002. So the maximum loss for a higher rate taxpayer is 42% of their capital. Maximum upside, unlimited and tax-free. And we have not taken into account any inheritance tax saving or any CGT saving we might have done along the way. So yes, the investment is high risk, but when you actually look at the tax reliefs and how much you can save, my goodness me, that risk is mitigated quite dramatically. And if we go back to my example of the person with the buy-to-let, you know, they've sold for 250,000. Yes, they've invested 50 into an EIS. But if they've not paid £14,000 in CGT and got £15,000 of income tax, that's 29,000 of the 50 they invested. So actually that investment's only cost them 21 to invest. And that's actually a small part of the whole, because don't forget that 200,000 you've released from selling that buy-to-let, and the £29,000 you got back in tax relief, you're going to put into normal investments. So again, can they afford to take that element of risk on that very small part of the overall? And that's just of that one asset, never mind their overall portfolio. So you're often investing a lot less than people assume, because people just look at that 50,000, well, it's a lot of money. Well, actually, is it in the scheme of things? Actually, probably not. And from your point of view, it's a great way of quickly getting funds under management. So what I often say is you use an EIS to get you out of something you don't want anymore. Share portfolio, bonds, your unit trusts, your buy-to-lets, your holiday homes. But you're going to do that without actually you do trigger the tax, but you can offset the tax. And this is what we expect to be in a typical portfolio. We'll expect out of 10, 3 companies could fail. 4 companies do okay, a couple do really well, and 1 is stunning. And that's why overall in our Ventures EIS portfolio, we're targeting 3 to 5 times return on capital. But actually, we won't invest in the company unless we think it has the potential of growing tenfold in our time period, which is 4 to 7 years. That's when we'd expect to be exiting these companies. But it's not an exact science, just to be aware. Well, actually, if you take that, if we're expecting a company to do at least tenfold, we only need 1 company out of 10 to do what it should do at 10 times. And we've got all our capital back. We've had loss relief on the other 9 companies, and we've had income tax relief up front. You're up over 50%. And you think, surely we can pick 1 winner out of 10. You certainly hope so. So to sum up, those are the tax breaks. VCT, you get your income tax, tax-free dividends, tax-free growth. EIS, you get your income tax relief, CGT deferral, IHT relief, loss relief, tax-free growth, CGT deferral, and you are actually allowed to put in up to £1 million per person per tax year, in fact 2 million with knowledge investment EISs. Now, I realise I'm running out of time here, but this is the team. We have a really excellent team. What differentiates us, though, is that our team are made up of entrepreneurs themselves, tech entrepreneurs. I love the fact with Dr. Ruben Wilcox, the fact he's got a PhD in chip design and inventor on 5 patents is the 6th most impressive thing on his CV. I think it speaks volumes. Dr. Nick Pillow, again, 6th on the list. He has his PhD from Oxford in computer vision. The beauty is these people have been there, seen it, done it before. They know what they're looking for in founders and for people to be exceptional. And then to help those people, we also have our venture partners. These are people who've got decades and decades of experience. Geraldine's a brilliant one. She's sits on the board of 3 of our companies, Booking Live, Client Share and Culture Shift. And she's a marketing guru, so she's there to help mentor, open up contacts, and really help those companies to thrive and become global companies, because that's what we're looking for. I mean, Ashley Unit, he sold his business for over $350 million back in 2018, like he does. And he sits on the board of CompareSoft. Again, he's there to help. A couple of companies that I wanted to mention. Tended, They are a safety device, absolutely brilliant. What I love about them is with their technology already, with one of the companies that they have signed up, which is Network Rail, they're expected to save at least one person's life a year just by wearing this safety device. Talk about ESG. Culture shift, anti-bullying. Now, they have already signed up half of the UK universities, and they've now signed up a private sector company. The potential for an anti-bullying app, it's just going to be huge. So, learning outcomes. Hopefully, you can all now think of when and how to use a VCT or EIS, but please don't forget, we are here as your BDM team to help you with cases. Do chat them through with us. And hopefully you can see how you can position those with your clients. You know, to be honest, it's just about, would you like to save more tax? Do we want to get clever with your asset allocation here? Do we want to move some money from where it's not really working for you over here, different asset class, part of a diversified portfolio, and we're going to get a lot of tax back as well. And then hopefully we've also covered about the risk. What's the real risk here? And if we're looking at EIS, when we factor in all those different tax reliefs that clients can benefit from and loss relief, actually, how much are they really risking here? But don't forget, from a compliance point of view, we're still always going to label them as high risk or 10 out of 10 from compliance, but you're going to say just for that particular pot of money. Unfortunately, we have run out of time for questions, but please do put them back, put them on this feedback sheet, and we will answer them and come back to you. Thank you so much for your time. We really appreciate you joining us today, and your BDMs are here and available to talk to you at any time or have meetings. We do Zoom these days, and if you want us to come out on client meetings or speak to your accountants or solicitors, we'd be very happy to do so. Thank you.